Welcome back to Yahoo Finance Live, everyone. As recession concerns remain high and market volatility remain a constant, our first guest this morning says that equity markets may have reached a peak bearishness related to Fed expectations and recession risk. For more, let's bring in Scott Chronert, who is the Citigroup Managing Director. So, Scott, peak bearishness, I mean, when you listen to some of the calls that have been made on Wall Street, even this morning, it sounds like that there's still some decline that could potentially be ahead.
Right. So let's frame the discussion a little bit here. So our view is that when you look at a variety of positioning, sentiment, and related indicators, the perspective is that in terms of a market response to concerns regarding recession and recession risk, we feel like we priced in something approaching to this peak bearishness, construct a couple of weeks back when the S&P was closing just around the 3,800 level.
Hey Scott, it's Julie here. I'm curious,
Julie,
what if you're looking at where we are in terms of peak bearishness or not, what are the sort of threats to that? In other words, what could potentially not be priced into the market here?
Okay, so our view has been that the rising rate influence, first as we moved from negative real rates to positive real rates, which started back in January and continued over the past couple of months, has created a valuation response that has essentially corrected the multiples, particularly on the growth side of the market, less so on the value side. But the implication in our view is that the rising rate influence on the market has mostly run its course. Most of what we're looking at in terms of Fed hawkishness is pretty well identified at this point. The issue from here becomes the move away from a valuation focus to more of an earnings expectation focus. And here we're of the view that we're probably still looking at some downward revision risk to the second half of 22, but more importantly, recession risk would really be a 23 earnings event in our view. So the takeaway here is that you have to begin to consider the recession risk, which we Citi are putting at 50-50 for 2023, and the market response literally a year ahead of that. And so the way we've been framing this is our base case for the S&P 500 is 4,700 by year end. That's essentially a soft landing scenario. We've also put out a recession scenario at 3,650. So when you look at where the market was trading a couple of weeks back near that 3,800 level, as we were arguing that rising rates were mostly priced in and that this peak bearishness construct around positioning was baked in, what you're left with is a toggle between soft landing and recession scenario, the issue here being increasingly on the earnings progression.
Scott, the 50-50 chance of a recession next year, what tips us into a recession?
Well, I think we need to see the persistency of inflation, right? So we're starting to see some signs of economic activity beginning to plateau or roll over. And I think like last week, for example, was sort of a trigger for, some of the market response. So what you begin watching for here is the Fed path. And we at Citi have been using over the next, 450 basis point hikes between most recent and into September. At the same time, you have to marry that with what's happening in terms of economic activity and conditions and some of the leading indicators. And so to the degree that the Fed is consistently viewed as a bit behind the curve and more emphatic about addressing the inflation issue, you end up running the risk of an overshoot, but I think it's premature to judge that, which brings us back to the point in case where we're looking at, sort of a 50-50 recession scenario. So essentially, incremental Fed hawkishness on top of economic activity showing some signs of rolling already is the formula that we need to, sort of bench against.
At what point do you believe that a recession show up in the economic data?
So this is the trick, right? So when you look at historically, you look at some of your indicators, whether it's, industrial production, some of the leading indicators, they'll tend to, approach that zero growth level just ahead of recessions. And at this point, we're again just coming off of peak levels. So you have to presume that a traditional recession is still many months off, if you will. And so trying to navigate this between where we are currently and where you might actually get to that condition is the trick. Now, we've been arguing that given the data availability in assessing inflation, Fed actions, and projected Fed actions, the market is able to discount much more quickly now, perhaps than in the past, how it positions ahead of that recession risk.
And so if all of that is the case, and you say the trick is getting from here to there as an investor, how do you do that? How do you position yourself to be nimble enough, right, for this sort of quick discounting mechanism that the market has become?
Right. So the way we've approached this is that, to your point, there's still a lot of uncertainty ahead that remains to play out here. And given the positioning commentary, we want to be careful about being too negative around the market circumstance. So what we've been arguing is for more of a focus on quality attributes as a means of positioning. Essentially, when you think of quality, you think of sort of more persistency of earnings or cash flow, lower debt ratios, higher profitability as a means of navigating this uncertainty in the months ahead. And that does a couple of things. We expect that at some level it protects some of your downside in ongoing sort of macro deterioration-led circumstance. At the same time, it gives you an opportunity and a means of participating should the market decide to rally from here, again, more aligned with the soft landing perspective.